My name is Dan Flatt. I'm the chief neighbor and co-founder at Neighborino. We're an early stage Toronto-based startup. We're going to be launching our app in the new year. And what we actually do is we're bringing together local communities of neighbors, focusing on apartment and condo buildings. And as we bring these communities together, we're actually giving them the opportunity to save money by combining their purchases from vendors in our marketplace through bulk purchasing, savings on consolidated deliveries, and that's really just the beginning. But I've had the privilege of working with Alex as we've been working on our friends and family fundraising round, and so I'll let Alex introduce himself.
Thanks, Dan. Yeah, it's great to be on chatting with you. My name is Alexander Morsink. I'm co-founder and managing director of Equivesto. Equivesto is an online investment platform and equity crowdfunding portal. We help private Canadian businesses raise capital from not just the sort of traditional angels and VCs, but also their extended community and the general public through our online portal. And conversely, we help all Canadians, not just accredited investors, invest into private businesses. And so we're here today to talk about a new way that's possible. It's been great working with Dan and the Neighborino team over the past several months on their friends and family round. And I look forward to improving and increasing the number of investors who can participate in great investments like Neighborino with these new rules.
Amazing. So I think, we're going to have a little bit of a question answer. I'm going to be asking Alex as the, really somebody who I consider the, one of the experts, at least in my network on these new regulations, on securities regulations in general, as it pertains to early stage fundraising. So, just as a little bit of background, before we actually started to even think about raising any outside capital, we were bootstrapping, self-funding Neighborino for a while, and then decided to, it was time to, take in a couple of checks from the people in my direct network, friends and family. And this is something that's usually done, if anybody in the audience has heard about the SAFE instrument that was first introduced by Y Combinator. That's the way that we decided to start raising our funds at the early stage from friends and family. As we were starting to figure out, okay, how do we actually go about this? I just happened to have a conversation with the team at Equivesto about their equity crowdfunding offerings, and we'll talk about how the difference between friends and family fundraising versus equity crowdfunding. And I think that we were actually one of the first companies on the Equivesto platform to do a private placement that wasn't equity crowdfunding. And so, one of the reasons we decided to go this way rather than just signing papers at a kitchen table with the friends and family who decided to invest was that we just found that it was going to be a lot easier to manage all the legal documents, get everybody registered properly. So that's the reason why we decided to go this way. Friends and family fundraising comes with a lot of restrictions. So I think we'll go into that as we start the presentation. So what options were available prior to the pilot? I think I spoke a little bit about it, but maybe Alex, I'll let you speak to, from your perspective, what defined this friends and family option the way it existed before this pilot that we're going to talk about later.
Yeah, certainly. And I maybe should have mentioned this during my sort of introduction about myself, but Equivesto is fully licensed as something called an exempt market dealer. And essentially what that means is Equivesto and the team at Equivesto is licensed to help broker private securities, private investments to a variety of investors, including the sort of general public and more traditional accredited investors. So we specialize in understanding how companies can legally raise capital as private businesses in Ontario and across Canada. So prior to this pilot, there's several restrictions around how private companies can raise capital. There's still restrictions in place after this pilot, but the pilot opens it up a little bit. Just as a bit of background, as a company, any company, when raising capital and allowing people to invest in your business, you still have to follow securities laws. So just because you're a private business doesn't mean you're somehow exempt from sort of all the securities rules. They still apply to you, even though you're not a public company. There's just different rules that you can use. So as a private company, because you're not going public and issuing a prospectus and listing on a stock market, you raise capital using a series of prospectus exemptions, which are basically legal doorways that let you raise capital without needing to go public. So this pilot is essentially to give the plot away at the beginning of the presentation. The pilot is a new legal doorway. But prior to the pilot and the addition of this legal doorway, there was some existing legal doorways. The first one being the most traditional, which is private placements. And so private placements allow you to use a series of different legal doorways. But basically, it's the friends, family, coworkers legal doorway and the accredited investor legal doorway. So if you're raising capital just in the sort of very traditional old school way, you need to know directly the people who are investing in your business. And the legal doorway for friends, family, and close business associates actually has distinct definitions of who can apply in each category. There's paperwork that people need to fill out when they invest through this. So the government defines a family member as basically an immediate relative, one generation up or down. So your parents, your grandparents, your sort of children, and your aunt and uncle, and your siblings. But it does not include the spouse of your aunt or uncle. Like, that's the level of restriction they have on what constitutes a family member in this definition. Friends is a little bit broader, but when filling out the paperwork, you literally have to define how you met this person, how long you've known them, and the nature of your relationship. And the government specifically says you cannot use joint membership in association or group, like, oh, this person is at the same club as me, or this person is at the same church as me, to fit under the friend definition. That's not enough. So they're very specific as to who applies. And essentially, this rule is really for people who know you personally very well. That's what the government wants. They want to make sure that only people who really know you and can judge you and your ability to run a business should be investing through this doorway. The other doorway is the accredited investor doorway. And just to remind everyone of the definition of an accredited investor, essentially, this is a high net worth individual who has over $200,000 in total income, or $300,000 combined with a spouse, or has over $1 million in net financial assets, not including real estate. So if you have $1 million house, sadly, you're not an accredited investor. You need to have your house and have $1 million on top of that. So those were the two sort of traditional doorways that existed. Typically, these early stage rounds, at least over the last sort of 6 or 7 years, were done, as Dan mentioned, on a safe note or a convertible note. Essentially, this is structured as almost like a loan where you're giving the money to the company, and then that money is not actually being used to buy shares right away. It's a amount of money you've given to the company, and then it will convert into shares in the future when a more professional investor typically comes and invests, and therefore you would follow the terms of that professional investor, but at least you're able to give the money to the company in advance. So this sort of traditional method had some real limiting factors. Really, you need to have wealthy people in your immediate network to fund you. So even though there's an accredited investor exemption and there's a friends and family exemption, if you get $100 from each of your family members, that's not going to be enough to build a $100,000 pilot. So you need to basically have wealthy connections, either immediate friends and family, or somehow you need to know accredited investors. So you still need the network of wealthy people. It was essentially kind of limiting capital raising and entrepreneurship overall to higher net worth individuals, which we don't think is very fair at all. Furthermore, going to external investors beyond your immediate network, traditionally, they're going to want to see something of value already built in the company. So if you are in the ideation stage, you've just come up with your idea, but you need $100,000 to build it, you can't go out to accredited investors to get the $100,000 to build it. They're typically going to want to see a minimum viable product or some sort of demo of the technology before they would be investing anything. So it really limits you to basically friends, family, coworkers, and your immediate network to get the money in to build the minimum viable product of your business.
That's an amazing summary. I think like everything I learned about this, I've learned from Alex during our conversations. One of the other, just from the perspective of a startup that has been trying to raise money through this channel, one of the conversations we've had very often with the Equivesto team is what kind of messaging are we allowed to actually put out when we're marketing this opportunity? I think a lot of people, we're doing this on LinkedIn Live. I think a lot of people know me from following the journey on LinkedIn.
Right.
And I was always checking in with Alex and the team to see what can I actually say about the fact that we're fundraising, or the fact that we've gotten a check or two in from friends and family who've already joined the round. And we have to be really, really careful about those things, because the reason these regulations exist is to protect the public from riskier investments. And if I was to position this as, hey, anybody can invest in this, that would be something that could actually get us in trouble with the OSC, which obviously we're trying to avoid at an early stage and going forward. So why don't we go on to the next option? Equity crowdfunding. So this is really, I think, Alex and Equivesto's bread and butter. So I'll let you take it away.
Thanks, Dan. And just to close out your comment on the marketing piece for an investment, essentially, as per securities law, it is illegal to go out and solicit for an investment unless the person soliciting you to invest is a licensed broker. So essentially, the idea being, going out and saying, like, if Dan on his own without a platform was to go out and say, hey, come invest in my business, it's going to be amazing, we're going to make some great returns, that would be considered to be against securities rules. You're allowed to notify people. You can notify people that you're doing something, but you can't sort of go out and broadly advertise. So there's all kinds of rules. Essentially, it's just to protect the public. Otherwise, every time any company was IPOing on the stock market, you would be bombarded with ads all the time, encouraging you to buy their new stock and whatever. So I think we like, we already get enough ads as it is. So there's definitely some controls around how you can go and kind of promote or talk about that you're raising capital. But, equity crowdfunding, there's clearly a wall of text in front of you all. That's there if you want to go through and read the slides afterwards. I'm not going to read through all of it for you. Essentially, equity crowdfunding is a great tool to allow companies to raise money. But equity crowdfunding, because the platform is involved, because you can't simply go out and run an equity crowdfunding round on your own, you have to do it through a platform. The platform has to complete due diligence on you. They have to complete suitability, KYC on every investor who signs up. All of this additional work and structuring, and because equity crowdfunding is really designed for much smaller size investors, writing little checks like $100, $500, $1,000, there's so many additional legal pieces that get involved. So not only is there the due diligence process up front, but also the company typically needs to modify its legal structure to create new share classes, modify the shareholders agreement, things like that. And so if you're in that kind of early stage and you're looking to bring in capital, you're not throwing yourself up on an equity crowdfunding platform in a week and just taking in some money. It's a several month process because you've got to do the legal changes. You need to prepare your community to come in and participate in the round. There's the due diligence that's involved, all these kind of pieces in getting an equity crowdfunding campaign ready. So it is a very viable way to raise capital, but it's still not getting you that early stage capital that you need when you're trying to go from ideation to minimum viable product. To raise on an equity crowdfunding round or on a platform, you still need to have a minimum viable product as well. And so you're not able to kind of dodge that from ideation to minimum viable product step where you have to actually make the thing that you're then going to try to get people to invest into. That's still there.
Okay. I'm already actually seeing some great questions from the audience, such as what the maximum total percentage is that you can have for equity crowdfunding. Are there any limitations around that?
When you're determining how much ownership percentage you're giving up during any fundraising, it's very simple. You're determining the valuation of your business and then you're determining the amount of money that you want to raise, and then it's just the ratio of the two. So if your business is worth $2 million and you need $500,000 to basically get it to the point where it's worth 2 million. Like if the business is worth 2 million after you build your prototype and you need $500,000 to build the prototype, then you need to offer 25% of your business, 1/4, 500,000 out of 2 million, to get the money in to sort of achieve what you're trying to achieve. So it's a very kind of straight line thing. So in terms of the maximum ownership that you could offer, there's no legal maximum. Obviously, you're going to be trying to retain control of the business. So you want to keep over 50% of the company. But there's, this whole process, this is not the LinkedIn Live for discussion around valuation and ownership structuring. Happy to have another LinkedIn Live on that, but I could talk for hours and I don't want to derail this chat.
I'd be happy to co-host that one with you once we get to that point. I was saying that we would leave some of the comments, some of the questions at the end, but I think that there's some coming in right now that are very relevant to what we're talking about. Talking about angel rounds, and would you say that is more related to the previous slide?
I defined on the previous slide what an accredited investor is. Someone with the 200,000 and the $1 million. Angels are a subcategory of accredited investors. When you're an accredited investor, you haven't gone off. Nobody's actually accredited you anywhere. You don't get a certificate. It just means that you have that income and you can prove it if somebody asks for it. So anybody who has over 200,000 in income, 300,000 with a spouse, or $1 million in net financial assets is automatically an accredited investor. Some accredited investors who choose to actively invest into startup businesses refer to themselves as angels. So they would be a subcategory of accredited investors, and they would invest like what Dan is describing as part of a private placement. Accredited investors will typically not, and angels as part of that, will typically not invest prior to minimum viable product of your business. And even these days, angel groups are looking to see companies have a minimum viable product and start having revenue before they'll consider investing. So in terms of running an angel round, that's still going to come essentially at the same time as you would potentially run an equity crowdfunding round. The amount of things you need to have completed in terms of, have the MVP finished, be properly structured, be ready to take on, external investment, that is all going to be coming after you've left the ideation stage and you're in MVP. But I want to keep moving forward because we haven't even talked about the reason why we're here. So let's just skip offering memorandum entirely. That's for companies raising 2 to 5 million plus audited financial statements. That's definitely later on. So let's cover some of the challenges, with early stage funding very, very quickly. So as I mentioned, you basically need to have built the thing in order to raise money on it. People want to invest in something when there's actually something that the company owns that they're buying. If all you've got is a pitch deck and an idea, there's so many people with ideas and there's so much risk in going from idea to product. Almost nobody is going to invest unless they really know you personally in that stage. And so that's where there's that piece of the problem. Once you've completed that, then you can start considering raising from, angels, equity crowdfunding, VC, all of those pieces. But still, that's going to require you to kind of be a bit later on. So that challenge is raising the capital to help build your minimum viable product, essentially.
And, I'll just add a little bit of color or some specific examples from our experience in Neighborino. At this point, we've actually built a prototype. We've spent almost a year in development of our own app. It's not functional yet. We just need to probably another month or two of development, and that's something that is easier to share with friends and family, where I can ask them for an hour to chat, show them what we have so far. Generally, when you're going to an angel group or VCs, they want to hear about your traction in a 5-minute presentation. It's harder to get all of that perspective in there. And, I think we've already spoken about some of the challenges around what we're allowed to say in mass marketing. I'm not really allowed at this point to just put out a LinkedIn post, saying to all of my first and second degree connections, hey, we're fundraising, here's a link to the page. But even second degree introductions up until recently, I one of the friends who and family who have invested in our current in our current campaign is actually one of my advisors, and we already have enough of a working relationship that we can, he'll qualify as a friend or a coworker. But he actually has several people who he wanted to introduce me to who up until very recently wouldn't have qualified under one of the existing categories because they also weren't accredited investors. So I think that this is actually a great segue into talking about what actually has changed at this point.
Perfect. So the Ontario Securities Commission has announced a new 18-month pilot. Essentially, this is another legal doorway. So again, there's the doorway for friends and family. There's the doorway for accredited investors, which includes angels and venture capitalists. Now there's a third, there's the equity crowdfunding doorway, which is doorway number 3. Now there's a fourth doorway, and this is called the self-certified investor exemption. And essentially this doorway says, okay, angel investors can come in because they're wealthy. But what about people who aren't wealthy yet, but have sophisticated knowledge about investing or finance or about the business itself that, for example, Navarino, they understand apartment buildings, they understand, buying in bulk, all the kind of things that Navarino is doing, they understand that. Do they get to participate? And all the old rules basically said no, they had to wait for an equity crowdfunding round. This new rule says if you basically can qualify as having adequate knowledge around investing or finance, you can invest up to $30,000 a year alongside other accredited investors and angel investors. So there's a clear definition exactly of what qualifies as the education. And we've got that in appendix along the slide. Can you go to the next slide really quick? Thank you. So they specifically outline exactly which educational degrees and certifications apply in business or finance. So this is stuff like the CFA, the CPA, MBA, having an undergraduate degree in finance or business with a major in finance, having passed the Canadian Securities course, being a lawyer with 1/3 or more of your practice focused on finance, specifically securities law or mergers acquisitions, being a certified financial planner, things like that. Also, relevant work experience. So if you have run a business or you've worked in a business that's very aligned to the same industry as the company that's looking to raise capital, you could potentially also qualify based on that. We have a full list of all of the requirements and how you qualify on our website, where I've linked there. And how do you then go and prove this? How do you demonstrate that you qualify? Essentially, you have to have the adequate documentation. So if you're CFA or an MBA, you have to provide a picture of your degree or your certificate to the platform to verify it. You'll also have to sign some additional risk declaration documents when you go through and make your investment. So how do we implement this on Equivesto? So Equivesto, by the way, is free for all investors. So you can sign up and create a full account at no cost. As part of the Equivesto process, we have to complete a full suitability and a due diligence on every investor who's signing up. So we're asking about things like income, net assets, so we can determine whether you're an accredited investor or not as part of the sign up, and help provide individualized investment limits for you based on your risk profile. We have 2 types of accounts that aren't accredited. Basically, the retail investor, which is just kind of everybody, the general public with, no income or net worth requirements. And then we have eligible investor, which is sort of like the step in between retail and accredited. So if you wanted to apply as a self-certified investor, you would sign up on Equivesto as either the retail or the eligible investor. And then you'll have an additional area where you can choose to proceed as a self-certified investor and then provide that documentation. This is all so new. We actually haven't rolled out that self-certified form just yet. It should be live later this week. So if you're saying, oh, I think I'm self-certified, I want to sign up, don't sign up just yet. Sign up in like 2 or 3 days once the updated forms are live. But we're rolling that out very shortly.
So Alex, I highly recommend, managing a fundraise through Equivesto, but for any founders who are listening who are, have been handling the paperwork for friends and family rounds themselves, how would they go about going through the self-certification process if they were going to be handling the fundraise themselves directly?
Yeah. So anytime you're raising capital, whether it's through a platform or not, and you're using any of these legal doorways, there's certain paperwork that has to be completed for every doorway. So let's say you're running a family and friends round, even though you're raising money directly and you're not sort of reporting to the regulators, there's actually certain risk documentation that every investor needs to sign, where they say the type of investor they are to you. This is where they basically disclose the nature of their relationship, how long they've known you, all that in this standardized documentation. It's the same for if you're raising from angels or other accredited investors. They have to declare how they qualify as angels and check all these different boxes. So when you're raising capital, you need a lawyer to provide those templates to you, or you can find a copy of them somewhere to include in your investment package that the investor is signing. There's one for family and friends. There's one for accredited investors, including angels. With the self-certification thing, there's another package of documents that's just been released that people need to sign. So one is kind of the risk disclosure. So the self-certified investor has to check a bunch of boxes saying, I acknowledge the risks, I acknowledge all these things, on and on. And then there's another one where they actually say how they qualify as self-certified. So they say, I have a CFA, or I have, if they choose the work experience, they have to say, I worked 5 years at this company in this role, and this is why it qualifies, and then sign and certify all that. So you need this paperwork to take their investment, and that allows them to participate as a self-certified investor. Big piece to keep in mind as well, the self-certified investor doorway lets them to participate up to $30,000 per rolling 12-month period. It's not $30,000 per deal. It's $30,000 per 12-month period. So if they do 10 grand in your deal, that only leaves 20 grand left to do in any other deal. So that's just something to keep in mind there. I saw a question in the chat about angel rounds, and I talked about what qualifies as an angel, but typically the minimum check size for an angel investor is $25,000. Once you start getting to check sizes basically $10,000 and smaller, you start getting into equity crowdfunding territory. Part of the reason being when you're raising capital, if you're doing the sort of non-reporting to the government way, you're using a category called the private issuer exemption. This lets you have up to 50 shareholders without having to do any filings with the government. Once you pass 50 shareholders, you can still raise from family and friends, accredited investors, equity. You can still do all that sort of stuff. You just have to file a report every time you raise capital at the end. And so if you're taking checks, 5,000, 5,000, 5,000, 5,000, you're very quickly going to eat up those 50 investors, and then you'll suddenly have to start doing the reporting piece. Part of the real challenge, though, is actually corporate governance. Corporate governance is not sexy at all, but most companies, when they're set up and structured, certainly as private businesses, are not really set up to have more than 5 or 10 shareholders. Once you start getting more shareholders than that, actually following the rules around how you manage your business can become very challenging if you haven't set up your business in advance to manage the number of investors you have and set it up properly. When you run an equity crowdfunding campaign, the platform helps you, or hopefully it would, or your legal counsel would. Equivesto certainly does. We help you structure your business to handle having many, many more shareholders. So if you're running a family and friends round and you let people come in, $1,000 each, you can do that. But your business itself is not actually structured to have 25 or 30 shareholders. There's going to be times where you're going to need to get sign off from every single shareholder you have. And if you have 35 investors, those are 35 signatures you need to collect next time you want to raise capital from anyone. And so it can become a real hassle to manage when you have more and more investors if you haven't done the structuring work in advance to prepare for that.
Great. As we see the questions come in, I'm just going to talk a little bit more about what, our perspective on what these rules mean. I think as we talked about before, it's been quite limiting to only be able to go to the people who qualified previously as friends, families, coworkers, the limitations on how we were actually able to communicate with them. So I think that now we're reorienting our communication strategy to broaden the messaging a little bit more as much as we're allowed to. That's definitely one major benefit we're seeing. As Alex was saying, like the limitations on the check sizes, with our friends and family around, we had to set a minimum check size of $5,000 just before we start getting into equity crowdfunding territory. And we probably are going to convert our campaign into a proper equity crowdfunding campaign at some point, probably after we've launched our app in the new year and get a little bit more traction that we're able to show to a much larger group of investors who could be putting in as little as $100 as their minimum investment. So those are some of the major benefits that we're seeing right now as we think about how we can get ourselves over this hump to really pay our developers to finish up our fundraising, do some of the early marketing that gets us a little bit more business traction that at that point will qualify us to fundraise from a lot of other dilutive and non-dilutive sources, including going to VCs and angels, equity crowdfunding, and even government loans and grant programs that just require a little bit more traction. So I think we see from Gaurav, minimum check size for angels, and can angels propose their own terms for safe convertibles to the founders? Alex, do you want to talk to that?
Yeah, I mentioned the minimum check size. Typically, it's $25,000, but you can also maybe do $10,000 in kind of unique situations. It used to be $50,000 and then has dropped now to $25,000 for the minimum check size. The valuation cap is a specific term relating to basically the maximum valuation that a company could raise at if you're investing through some sort of convertible note. It's referring to the maximum valuation that the shares might convert at. Valuation caps are set, and they're basically like setting a valuation for your business. So setting the valuation cap is something that you are going to do as a company, and you need to have a valuation cap in mind or evaluation in mind when you go out to begin raising. So it's not like the angel or like there's like a standard, everybody has the same valuation cap when you raise. There are standard valuations and ranges that are expected for companies at certain stages. So if your business is in the pre-seed stage, then the expectation is that your valuation is kind of, 3 to 5 million, and then seed is sort of 5 to 10. Like there's these sort of standard expectations from angel investors and from VCs around valuations and stages, but you need to understand the valuation of your own business, and you need to be assessing your own valuation and sort of bringing that forward as part of your round. In terms of can angels propose their own terms for a safer or convertible note, when you're running a round, typically there's going to be one angel investor who let's say you're running an angel round, there's going to be essentially you'll try to find one angel investor who's going to essentially quote unquote lead the round. This person is going to do the work to sort of work with you to determine fair terms for investment. Once you've found that fair terms for investment, then all the other angels would invest under the same terms. You cannot run two financings at the same time under different terms. Shares have an underlying value. So if you're selling shares to one person at $1 and you're selling them to another person at $2, the person who's bought them at $2, the value of their shares is dropping by 50% as soon as they buy them, because you're also selling them to someone else at $1. So that investor is going to hate you because they paid $2 and this other person paid $1. You want to be in a situation where your valuation is slowly going up from financing round to financing round, but you can't be in a situation where this person's investing at these terms and this person's investing at these totally separate terms at the same time. Getting investment in is kind of like getting married. You've been dating, you get engaged, but when they actually invest, that's when your marriage begins. You're about to have 50 years with that person as your partner. And you don't want to start by saying, oh, congratulations, honey, we just got married. I cheated on you last night with the entire bridal party. That's not a great way to start your relationship. So you want to just be careful around having multiple terms. I see another question from Victor. Would equity funding provided by some banks be an easier option? I've never heard of banks providing equity funding. Banks typically don't invest and buy shares in companies. They typically provide loans, which would be not equity funding. That would be debt funding. In terms of debt funding, usually debt funding is on the basis of underlying assets that can be held as collateral, which are then collected by the bank in the event of default. Most banks will only lend to small businesses that have physical assets. So you're building a manufacturing plant, they'll take the building, they'll take the physical, manufacturing machines, all that sort of stuff as collateral against the loan. If you're running a startup that's technology based and you don't have any physical assets, the bank will typically not lend you any money against that, and they'll instead have the loan be guaranteed by you personally. And the amount of capital you're looking to raise to actually achieve goals like $500,000, $800,000, $1 million, no bank is going to sign that over to a person who hasn't run multiple businesses before and doesn't have millions of dollars. Furthermore, the interest rate on the debt is going to be so much higher because the risk of failure of your enterprise is very high. Venture debt typically has an interest rate of 25 to 30% per year, which is even at a far later stage than a startup. We're talking about debt to businesses that are already operational and potentially have millions in revenue, and they're paying basically credit card level interest rate on their debt. Banks typically don't lend to early stage businesses.
Is that like around what Elon Musk is paying on the debt that he used to finance the Twitter acquisition?
That's a little bit different because he's public. He can put up his own holdings for securities in Tesla and other places. So he's probably paying, the overnight bank rate or something like that. Very, very low interest on that. To answer your question, Melissa, about Equivesto and how we operate, we're an online platform with thousands of investors, but the reality of raising capital as a new startup is that there's no guarantee that any investor on the platform is going to participate in your financing. And so really where we work, because we want to help make sure that you have a successful campaign. And the way to do that is to make sure that you are attracting all of the investors and the network yourself. Working with a platform helps provide the sort of operational and legal paperwork. We help with the structuring and kind of all of these pieces so that you're doing it in a compliant way. We also can allow you to actually talk about it more publicly. So as Dan was mentioning, raising capital directly on your own, you can't go posting on social media about it because that is illegal solicitation of securities. When you're working with a platform, you're allowed to talk a little bit more about the raise because the platform is the intermediary. People are not going and giving you the money directly. They have to sign up, their account has to be approved, and the platform has to determine that they're suitable and they understand the risks of making a private investment. And that sort of protection, as well as the due diligence the platform is doing on the company itself, is there to sort of protect people and sort of minimize the likelihood of somebody investing accidentally into a scam or something like that.
And I can talk about with our experience with Neighborino on Equivesto, because we're doing a private placement. Our campaign is not going to be listed on the same page as all the equity crowdfunding campaigns, where registered Equivesto investors could actually browse through opportunities that they're qualified for. Up until now, we've actually just had a private link that we need to send out once we've already qualified through an additional step that these the people who are interested that they're actually eligible to invest in us. So then we can send them the private link that has all the information about our company, our pitch deck, how much money we've already raised to date. And so actually, Alex, I think this is a good question. Now that we've got these new rules in place, do you see any loosening up on those restrictions on how we're actually able to talk about our opportunities?
Yeah. So now, before you were basically going out and talking to family and friends, and you were talking to accredited investors in your network. Now with the new self-certified investor, you can basically expand the pool of people who you can talk to about it to individuals who would probably qualify under any of the bullet points on the screen. And they would be able to invest at the same terms as the angels and the friends and family. So it would still be the sort of minimum 5,000, everything like that. But what the rule is doing is basically saying you don't need to have $1 million. You don't need to have $200,000 in income to be able to participate in this private round. if you're going to if your goal is like, oh, I want to allow in 100 investors this way, then equity crowdfunding is still the better choice, because then you're structuring the company to handle lots more investors. You're doing additional kind of preparation and paperwork to manage that piece of it. But if really what you're saying is, I have a network of people who have some funds and would like to potentially invest in my business, but they're not millionaires yet. They're well educated. They have, they're growing in their careers, but they're in their late 20s, early 30s, or, late 30s, but they haven't reached that sort of $1 million mark, but they have this sort of proven knowledge. They can participate in a limited capacity with these higher check sizes. So they would come through kind of the same private link, the same doorway, but it would be, these are the things that they would need to make sure to qualify as. And if they wouldn't have these things, then we wouldn't be able to let them invest.
Yeah, so I think we're about 15 minutes past an initial half hour. The great questions coming in, but I think that we'll probably start to wrap up now. I just wanted to add in one thing that we just wanted to announce at Neighborino. One of the challenges, as we said, about generating traction and revenue that will qualify us for investors. While we're waiting for our app to be ready, we actually are going to be launching a holiday promotion. We're bringing together a lot of the vendors who are going to be featuring in our marketplace in the new year, and curating a few different gift baskets featuring local products. And a portion of all the proceeds are going to be going to benefit the Daily Bread Food Bank. So I'll be posting about that on LinkedIn later. I think we'll also be able to send out this deck to everybody who has participated, even some of the people who registered and weren't able to join today. And Alex, is there anything else that you wanted to add before we wrap up?
Yeah, I just want to thank everyone for joining. If you're interested in learning more about investing in private companies or raising capital as a private business, Equivesto actually has an extremely detailed learning center, and we're rolling out more and more free educational content, including a full course on everything that you need to know about investing in private companies and being an angel investor and everything on our website at equivesto.com/learn. So if you have more questions and you want to sort of start learning about this, you can head to equivesto.com/learn. We have probably 500 plus hours of free content that you can grab, and we're rolling out new stuff all the time.
Okay. Thank you very much, Alex. And thank you everybody who's joined today.